After the failure of IL&FS, Punjab and Maharashtra Cooperative Bank and DHFL and the bailout of Yes Bank, the Reserve Bank of India decided to impose a 30-day moratorium on Lakshmi Vilas Bank Ltd and put in place a draft scheme for its amalgamation with DBS Bank India, a subsidiary of DBS of Singapore. DBS Bank will bring in additional capital of Rs 2,500 crore upfront to support credit growth for the merged entity. This has raised concern about the safety of the financial system. The RBI said the financial position of the Chennai-based LVB, which has a network of 563 branches and deposits of Rs 20,973 crore, has undergone a steady decline. Continuous losses over the last 3 years have eroded the bank's net worth. The bank has not been able to raise adequate capital to address these issues. It was also experiencing continuous withdrawal of deposits and low level of liquidity. Serious governance issues in recent years have also led to deterioration in its performance. LBV posted a net loss of Rs 397 crore in the September quarter of financial year 2021 as against the loss of Rs 112 crore in the June quarter. Almost one-fourth of the bank's advances have turned bad assets. Its gross non-performing assets stood at 25.4% of its advances as of June 2020 as against 17.3% a year ago. A recent merger proposal had come from Ion-backed Clicks Capital, but the discussions didn't work out. The bank was earlier wooed by SREI Capital. It almost tied up with Indiabulls Housing Finance, but the RBI objected to the merger proposal. The bank management had indicated to the RBI that it was in talks with certain investors, but failed to submit any concrete proposal. The RBI, which puts a cap of Rs 25,000 on withdrawals, has assured depositors of the bank that their interest will be protected. The combined balance sheet of DBS India and LVB would remain healthy after the proposed amalgamation, with capital to risk weighted asset ratio at 12.51% and the common equity tier 1 capital at 9.61% without taking into account the infusion of additional capital. The RBI had earlier this year bailed out Yes Bank through a scheme backed by State Bank of India and other banks. One safety net for small depositors is the Deposit Insurance and Credit Guaranteed Corporation, an RBI subsidiary which gives insurance cover up to Rs 5 lakh deposits in bank. The RBI and the government has often assured that the financial system is safe and sound, but a spate of failures have the potential to affect the confidence of depositors. Shareholders in Yes Bank faced a similar erosion in wealth as the stock price crashed from Rs 10 per share from a peak of Rs 400 per share. In case of LVB, equity capital is being fully written off. This means existing shareholders face a total loss on their investments until there are buyers in the secondary market who may ascribe some value to these. Shares of LVB closed at 20% lower circuit Wednesday. In its draft scheme for the amalgamation, the RBI said that on and from the appointment date, the entire amount of the paid-up share capital and the reserves and surplus, including the balance in the share and securities premium account of the transferor bank, shall stand written off. In case of Yes Bank too, some individual investors faced a total loss on their investments in AT1 bonds. Nearly Rs 9,000 crore worth of Rs 81 bonds sold to various institutional investors and to high net worth individual investors in the secondary markets were fully written off. As per RBI rules, based on the Basel III framework, AT1 bonds have principal loss absorption features, which can cause a full write-down or conversion to equity.